Stock market. How do you feel when you hear the name? Does the fear of losing money come to your mind? Or do you see an opportunity to earn a lot of money? Hey brother, whether it is the stock market crash of 1929 or the bursting of the dot-com bubble, history has scared us a lot. These worries are absolutely real. What if we chose the wrong stock? What if the market goes down? Sounds risky, right? But wait. What if I tell you that you don't need to be afraid, you need to learn? What if there is a method, a tried and tested system that can make you win in this game of risk? Yes, today on Book Bytes AI, we are going to dissect a very powerful book, How to Make Money in Stocks, a winning system in good times and bad, written by WilliamJO'Neil. William O'Neill has spent years researching ways to make money in the stock market despite its ups and downs. This book teaches you how to learn from history's biggest winners and losers, pick the right companies, know the right time to buy them, and stay away from unprofitable investments. So, buckle up. In this video, we learn some of the most powerful lessons from this book. We'll learn what are the telltale stock chart patterns that point to big profits. What kind of companies are most profitable to invest in? How can you create your investment strategy to maximize returns and avoid big losses? If you're serious about making money in the stock market, this video is for you. Let's get started.
Lesson 1. Chart Secrets. Ride the winners with the cup with handle. All right, Team Book Bytes AI, we are at our lesson number 1. Did you know that the secret to making money in the stock market is hidden in history? Yes, believe it or not, history repeats itself in the stock market. Think about Northern Pacific Railway 100 years ago, or today's super hit Apple. Winning stocks, losing stocks, and stocks that just languish. There are patterns behind them that don't change. What does this mean? We can learn from past behavior and make smart moves in the present. This is just like a doctor looking at X-rays, MRIs, or brain scans to know the condition of your health. Or like geologists use seismic data to find out where the oil reserves are hidden. What are they doing? They are looking at patterns that are repeated again and again. This is what happens in the stock market too. The data of the last 100 years is an open book for us. If we learn to read it, we can know when to make a strong entry in a stock and when to quietly exit. Most investors don't do this hard work and then blame luck when money sinks. But not you. You will learn to read patterns. So, which pattern is that magic wand? William O'Neill says that there are many patterns, but one pattern is the most special, the most powerful, and its name is also very interesting, the cup with handle pattern. Yes, a cup and its handle. Imagine, 1. A stock is moving up. 2. Then profit is booked and it comes down forming a rounded U shape. This is the bottom or base of the cup. This shows that there is strong investor support here. The stock will not fall. 3. Then the stock gains momentum again and moves up, forming the other side of the cup. But wait, right after reaching the top, it slips down a bit, moves sideways. This forms the small handle of the cup. And that's it. Bingo! This is the golden moment. O'Neill says, as soon as the stock breaks above this handle part, that is the right time to buy. Buy, buy, buy. This is no fluke. From sea containers in the 1970s to Apple in the 2000s, this trusted cup with handle pattern has given investors tremendous returns for decades. This pattern works again and again. So what is the gist of lesson number 1? Make stock charts your friend. Learn from history. Recognize the patterns, especially this cup with handle, and you can ride with the market winners.
Lesson 2. Earnings Power, the number 1 secret to picking winning stocks. Champions, lesson number 2 has arrived. In the last lesson, we learned the language of charts. Now we will know what is the fuel that makes the stock price rocket fly. The answer is very simple, friends. Profitability, money, earnings. A successful business means increasing stock price, right? So what is WilliamJO'Neil's simple mantra? If you want to pick real winners in the stock market, then look for those companies whose earnings, that is, their earnings, are growing at a stormy pace. Yes, strong earnings growth is the biggest, most important identity of a superstar stock. History shouts this out loud. Remember tech giants Google and Apple. In 2004, Google's share was $85. By 2007, it crossed $700. Mind-blowing. Apple from $12 to $202 in just 45 months. How did this magic happen? Yes, of course, they were doing amazing innovation, but where did the real turbo boost come from? From their earnings. Google's earnings grew by 112% and 123% just before the stock took off. Apple, get ready. Earnings grew by 350% in the quarter before the stock took off. That is insane growth. This is the power of earnings. But wait a minute, there is a trap here too. Don't fall for big rumors of future earnings. Remember the dot-com boom of the 90s? There were so many companies that had no real earnings to show, just wild talk and dreams. Investors kept investing money in excitement, and then, boom, crash. All those speculative companies flopped badly. But tech companies that had solid, real earnings even at that time, like AOL, Yahoo, suffered very little loss. So what did you learn from this? The lesson is very clear. Invest only in companies that have real earnings, which are visible and which are constantly growing. You need proof, not just hopes, etc. Okay, so where to look for these magical earnings? Focus on EPS, that is earnings per share. What is this number? Very simple. Take the total profit of the company after paying taxes and divide it by the total outstanding shares of the company. You got EPS. You have to find those companies whose EPS is growing by a large percentage every quarter, every year, consistently. Consistency is the name of the game. Yes, O'Neil clearly says that you should not buy stocks blindly just by looking at EPS growth. There are other important things to look at, which we will discuss in detail in the next lessons of Book Bytes AI. But to take a buying decision, the first and most important factor to check is EPS growth. It is non-negotiable. So the bottom line of lesson number 2, forget the hype, focus on the numbers. Strong, consistent EPS growth is the real fuel that can take your chosen stock to the moon. Keep your eyes on the earnings.
Lesson 3. Innovation pays. Spotting game changers and when to buy high. Get ready for lesson number 3. Did you know that there is a deep connection between crazy ideas that change the world and the huge profits that can be made from the stock market? Absolutely. Just look at the entire story of America. From Thomas Edison's shining light bulb to the digital magic of Silicon Valley, innovation has always filled investors' pockets. Done. History is witness to this. From 1880 to today, the stock prices of companies that presented something different, something revolutionary to the world, have rocketed. Remember, innovation and tremendous stock market returns are two sides of the same coin. Done. Just think, Northern Pacific, which built the first transcontinental railroad, a whopping 4,000% growth in just 2 years. General Motors, GM, when they introduced their new cars, a jump of 1,368%. And Cisco Systems, which changed the world of network equipment. Believe me, 75,000% growth between 1990 and 2000. 75,000%. Done. This is the power of real innovation. Okay, I know what you are thinking. Oh man, I missed Apple, I missed Microsoft. Done. Worry not. The world is full of innovators.
Even today, at this very moment, new game-changing companies are being born. What is needed? To identify them and take action at the right time. Done. And now, here comes the biggest twist of this lesson. Done. We all have heard since childhood, learned from elders, if you want to make money in the stock market, then buy low, sell high. Buy cheap, sell high, right? WilliamJO'Neil says, wrong. Done. Forget this formula for at least these revolutionary, game-changing companies. Done. Surprised? O'Neill's logic is absolutely solid. A truly great, innovative company often breaks all predictions and grows even more than expected. So if there is a super innovative stock that is constantly making new highs, then don't be afraid, don't hesitate to buy it even if it already seems expensive to you. Don't be afraid to buy high. Done. Reinforcing with example and data. Remember Cisco again. In 1990, it was already at its all-time high, and after that it made that historical jump of 75,000%. A study by Investors Business Daily also says the same thing. Stocks that make new highs in a bull market often go on to make even more new highs. And those that make new lows go even lower. Momentum matters. Done. But, done. This does not mean that you should blindly buy at any time. As we had emphasized in the previous lesson, timing is everything. Done. When should you buy? When the stock is ready to give a strong breakout after consolidating its base. Remember the couplet handle pattern from lesson 1? Done. Price may be high, no problem, but the technical signal to buy should be absolutely perfect. Done.
Lesson 4. Market movers. Decode supply, demand, and insider secrets. Time for lesson number 4. You go to the market, buy cheese, toothpaste. How is the price decided? Brother, simple. How many things are available, supply, and how many people want to buy it, demand. Guess what? This fundamental law, this game of supply and demand works in the stock market too. And understanding this is super important for your profit. Let's talk supply first. That is, how many shares are there in the market? Imagine two companies. Company A, which has 5 billion shares floating in the market, waves. Company B, which has only 50 million shares, drops. Now think, how many buyers' army will be needed to take the share price of Company A up? There will be tremendous buying. But Company B, whose shares are very less, as soon as demand increases a little, as soon as there is a little buying, its share price can rocket. Why? Because supply is less. The lesser the shares, the more dramatic and explosive the price movement will be. So less shares equal to more potential profit? Yes, explosion. But there is a catch here. As fast as the small cap stock can rise, it can also crash down with the same speed. Downtrend. It is a case of high risk, high reward. On the other hand, a large cap company like Company A with more shares is more stable. Price movement is slow, risk is less, so maybe explosive returns are also less. You have to choose. Okay, is the concept of supply clear? Now let's come to the real thing, demand. And here is hidden another secret weapon of WilliamJO'Neil. See how many shares of the company the top management, CEO, directors of the company have bought themselves. Think, if the top dogs running the company have not invested their own money in the company, will it matter much to them whether the company does well or badly? Probably not. This could be a big red flag for you. Their interests might not be aligned with yours. But if you see that the top management itself has a significant share in the company, O'Neil says at least 1 to 3% in a big company and even more in small companies, then brother, this is a tremendous green signal. This means skin in the game. They have invested their own money. Their benefit is linked to the company's benefit. They will work day and night to make the company successful. That's the kind of company you want. What is another powerful indicator of demand? When the company itself starts buying back its own shares from the market. This is called stock buybacks. Money. Why is this a very positive sign? The supply of shares available in the market decreases, which can increase the value of the remaining shares. This shows that the company's management feels that their stock is undervalued and that future earnings are going to be tremendous. They have tremendous confidence in their company. Confidence is contagious.
Lesson 5. Winner takes all. Invest in industry leaders, not just familiar names. Lesson number 5 has arrived. Ready for another truth bomb? Okay, tell me with your hand on your heart, do you often invest in companies whose products you use, with which you feel a connection, like cold Coca-Cola or Nike shoes on your feet? Feels comfortable, right? A well-known, trustworthy name? WilliamJO'Neil says, alert, this comfort approach can cost you dearly. In a tremendous bull market, these old, dear darlings often remain sitting on the sidelines, while the real industry leaders hit sixes on the field. So who is this leader? Is this the company with the biggest name, the one whose advertisements appear the most? Absolutely not. In O'Neill's world, leader means performance king. The company whose numbers themselves testify, I am the best. Leader means strongest quarterly and annual earnings growth, point from lesson 2, strongest sales growth, widest profit margins, highest return on equity, ROE, and yes, a unique, game-changing, innovative product, remember lesson 3, that is delivering all these amazing results. The golden rule is simple. Identify the number 1 company in your industry group and bet on it, the undisputed champion. Using examples for impact, the stocks that O'Neil himself made a lot of money from were all number 1 in their time, be it Pick and Save in the 1970s, Amgen in the 90s, AOL in the late 90s, eBay in the 2000s, or Apple in the 2000s. They were all leaders dominating their space. And remember the great bull market of 1979-80, when new dynamic leaders like Wang Labs, Tandy, and DataPoint grew up to 7 times. And what was the condition of the old giants, the most popular, everyone's favorite IBM and Burroughs at that time? Sluggish, static. The lesson is clear. Just being old and reliable does not guarantee that it will give you explosive returns like leaders. And one of the most common mistakes investors make? Leaving the real leader and investing in the follower, number 2 or copycat company. People think, hey, he's also in the same industry, he will also get a little influence of the leader. Wrong. This rarely works. Remember the words of the great industrialist Andrew Carnegie. The first man gets the oyster, the second the shell. Meaning the first one, the leader, gets the real cream, the pearl. The second one, the follower, only gets the shell. Markets are run by real innovators and entrepreneurs, not copycats. So what is the action plan for lesson number 5? 1. Say bye-bye to emotional investing. Don't just run after well-known names or comfortable brands. 2. Do your research. Find the real leaders of your industry, the companies that are leading in performance, earnings, sales, ROE, and innovation. 3. Focus on number 1. Avoid the laggards and copycats. Back the winner. This is the way of smart investing, Book Bytes AI style. Let's move on.
Lesson 6. Follow the smart money. Decode institutional buying secrets. Time for lesson number 6. Emoji detective face. Have you ever wondered who actually controls the waves of the stock market? Retail investors like you and me? A little bit, yes. But who are the real whales, the real giants, the real heavyweights of the market? They are big institutions. Mutual funds, pension funds, insurance companies, hedge funds. They have firepower of billions and trillions. And another masterstroke advice from WilliamJO'Neil: keep a vulture-like eye on their every move. This is called institutional sponsorship. That is, when these big financial giants, along with the expert managers, start investing heavily in a particular stock. Why is it crucial to know this? Because these institutions do the most stock buying and selling in the world.
They literally drive the market, emoji car going at fast speed. When they are bullish on a stock and start buying it, there is a huge demand, and the price of the stock, where will it go? Up, 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 emoji rocket shooting into the sky. If you have stocks in your portfolio that these big boys are buying, then understand that you are in the right boat. You're riding the wave with the whales. Okay, so should we run after every institution? O'Neil says no. Focus on the best of the best, on those top-performing funds whose track record of annual returns is excellent. Emoji trophy. Their fund managers are considered to be the sharpest, most insightful investors in the market. See which stocks these champions are buying. Their choices often signal future winners. Where will you get this golden information? Resources like Investors Business Daily, IBD, and Morningstar.com can help you. On Morningstar.com, you can also find a list of the latest top holdings, that is, the biggest stocks in their portfolio of these top mutual funds. This information is nothing less than gold. And if you want to know how these pro investors think, what is their strategy, then read the fund's prospectus. You will find this document on the fund's website. This will give you an idea of their stock picking philosophy and techniques. Knowledge is power. The critical caveat: don't follow blindly. But there is a very big but here. Emoji traffic light turning from green to yellow to red. Be careful, don't follow anyone blindly. What happens sometimes, a stock becomes so favorite of the institutions, so overowned, that they just keep buying it forced by habit, even if the fundamentals of the company are deteriorating. Classic example, Xerox of the 1970s. It was the darling of the institutions. What an amazing track record it had. But some smart, independent analysts saw that everything is not right inside, and in no time, the stock took a plunge. So what is the biggest lesson from here? Learn from the best, track the smart money, but always, always do your own homework. Emoji brain. Research of others is a starting point. Institutional buying is a strong confirmation, but your own due diligence, your own analysis is the most important. Nothing beats your own conviction.
Lesson 7. Market is king. How to read the trend and ignore the noise. And here we are, Book Bytes AI Warriors, the grand finale, lesson number 7. You learned killer chart patterns, lesson 1, power of earnings, lesson 2, recognizing innovation, lesson 3, supply-demand secrets, lesson 4, choosing leaders, lesson 5, and following smart money, lesson 6. You guys are now armed with incredible knowledge. But all this hard work, all this strategy can go waste if you ignore the biggest power of the market. And what is that? The general market direction. In emphasizing the core message, William O'Neil says with full force, market is king. Remember this statistic. When the market is going down, bear market, 3 out of 4 stocks fall, no matter how good they seem. Think about the 2008 crash. No matter how great your stock picking was, if you were against the market trend and did not get out at the right time, then the loss was certain. Going against the market trend is like trying to swim in the opposite direction in a stormy sea. You will get tired, you will drown. So, what is this general market? Simple. You should keep an eye on the major market indices. Which ones? The big 3. The S&P 500, the Dow Jones Industrial Average, DJIA, and NASDAQ Composite. These indices show you the overall health of the market, its mood. Okay, so how to track the mood of this market? Make this your daily habit. 1. Check daily. See where the main indices closed every day. Up, down, sideways? You can easily find this online. 2. Look at the volume, accumulation versus distribution. Is there a lot of buying, big players investing, accumulation, or a lot of selling, big players exiting, distribution? Resources like Investors Business Daily, IBD, provide you with this data. This shows whether there is confidence or fear in the market. 3. Look at the daily price action.
Super important. Are stocks opening high in the morning but closing low by the end of the day? This could be a bearish sign. The market is weakening. Be careful. Or are stocks opening weak in the morning but closing strong by the evening? This could be a bullish sign. The market is coming back to life. Now, $1 million advice. To understand the market, watch financial news channels on TV all day, read tons of expert opinions and newsletters. O'Neil says, big no. These are mostly expensive distractions. One expert will say the market will go up, another will say crash is coming. You will get badly confused. O'Neil's analogy is brilliant. Think if you want to know everything about tigers, then what is the best way? Just reading books written about them? No, the best way is to go to the jungle and observe tigers in their natural habitat. Watch their actions, isn't it? The stock market is also a wild beast like the tiger. To understand it, what is the best resource? Market itself. Look at the daily action of the market. Observe its mood swings, its movements. Price and volume action don't lie.
So those were 7 powerful, action-packed lessons from William J. O'Neil's legendary book, How to Make Money in Stocks, here on Book Bytes AI. So, let's do a super quick recap of what we learned. Lesson 1. We learned how to read the language of charts, especially the game-changing cup with handle pattern. Lesson 2. We learned that strong earnings growth is the most important fuel for a winning stock. Lesson 3. We saw the power of innovation and how to identify real game changers. Lesson 4. We decoded insider secrets like supply, demand, management ownership, and stock buybacks. Lesson 5. We learned to focus on real industry leaders, not just familiar names. Lesson 6. We understood the importance of institutional sponsorship. Follow smart money, but use your brain. And finally, market is king. Investing is incomplete without understanding the general market direction. But wait, one last critical piece of advice from William O'Neil that can save you from big losses. Want to know? It's simple but powerful. Cut your losses early. In investing, it is not enough to know when to buy. It is even more important to know when to get out, especially when you are wrong. O'Neil has a simple rule. If a stock falls 7 or 8% below your buying price, do not think too much. Lock your emotions and sell immediately. Why? Because protecting your capital is priority number 1. Only by cutting small losses quickly can you stay in the market and get a chance to ride big winners. Small losses, big wins. That's the goal. The Kanslem method, whose principles we discussed in these lessons, is time-tested and has helped countless investors build wealth. Knowledge is power, friends, and now you have this power. So if you got even a little value from this video summary, if your mind was opened, if you learned something new, then what are you waiting for? There is that red subscribe button below, right? Click it hard, click it now, and become a part of the Book Bytes AI family. We will keep bringing you such powerful book summaries, investing strategies, and financial wisdom here. Do let me know in the comments section which one of these 7 lessons was your favorite. Which lesson resonated with you the most? Do let me know in the comments section below. And finally, thanks for watching Book Bytes AI. Keep learning, keep investing wisely, and keep growing. I will meet you in the next blockbuster video. Until then, take care.